The market is like a massive game arena, where every trade represents a psychological battle between different players. Today we are revealing a strategy that brings game theory principles into trading systems. By identifying how different market participants play their games, we can find winning opportunities in this multiplayer battlefield. Welcome to the Inventor Strategy Selection channel. We focus on finding the most classic and cutting-edge mature strategies in the crypto space. In financial markets, every price move is not random. It is the result of different interest groups playing against each other. Retail traders act on emotions. Institutions operate with information advantages. And market makers profit through liquidity provision. This creates a complex multi-party game system. Traditional technical analysis only shows us price and volume on the surface, but it cannot reveal the game theory dynamics underneath. Our strategy is built on this insight. It treats the market as a multi-party, incomplete information game. By identifying behavioral patterns of different groups, we build a complete game analysis framework. The core idea is simple. Understand how other players think, predict their strategic choices, then craft your optimal response strategy. This gives us both information advantage and behavioral advantage in the market game. This strategy's core innovation lies in systematically converting game theory into an executable trading framework. We classify market participants into three key groups: emotion-driven retail traders, institutions with information advantages, and professional liquidity providers. Based on this classification, the strategy builds four core analysis dimensions. First, the herd behavior detection module. It uses RSI extremes, volume anomalies, and price momentum divergence through triple verification to precisely identify extreme emotional states. Second, the liquidity trap identification system. It monitors technical breakouts combined with psychological price levels to identify how big money uses retail stop losses for liquidity hunting. Third, the institutional money flow tracking mechanism. Through accumulation distribution indicators and smart money index, it tracks professional money's real intentions and directions in real time. Fourth, the Nash equilibrium pricing model. It uses statistical methods to calculate the market's theoretical equilibrium price range, identifying when prices deviate from equilibrium. Based on these four analysis dimensions, the strategy generates three core signal types. Contrarian signals combine herd behavior and liquidity traps to find reversal opportunities in group irrationality and market manipulation. Momentum signals follow institutional money flows and equilibrium deviations to capture trending opportunities. Equilibrium reversion signals use price correction mechanisms to capture reversion forces when prices deviate from equilibrium. Combined with dynamic position management, it achieves optimal risk-reward allocation. The parameter design reflects systematic game theory thinking and deep understanding of market participant behavior. The RSI period of 14 days in the herd behavior analysis module has game theory foundations. This is the widely recognized overbought, oversold standard. Precisely because everyone watches this indicator, it becomes an important trigger for herd behavior. When RSI reaches 70 or 30, many technical traders take the same action, creating herd effects. The 5-day volume up period and 2.0 herd threshold design ensures the strategy can identify emotional outbursts in short periods, quickly responding to sudden emotional changes. The 5-day scanning period for liquidity analysis focuses on capturing short-term liquidity gains. This is the typical time window for big money to conduct rapid hunting. When technical indicators most retail traders watch get broken in short periods, that is when liquidity traps form most easily. The 2.5x volume multiplier for institutional money flow detection specifically identifies large transactions beyond retail capabilities. The 5-day MA period effectively identifies institutional phased positioning intentions. Nash equilibrium parameters embody game theory essence. The 4-day ultra-short period design adapts to crypto markets' high-frequency game characteristics. Compared to traditional financial markets, digital assets have faster game rhythms, and participant expectations form and adjust more quickly. The 2% deviation rate considers both natural market fluctuations and maintains equilibrium theory effectiveness in high-volatility environments. Finally, stop loss and take profit parameter settings ensure controllable trading risks. Herd behavior detection is the core application of game theory in quantitative trading. By identifying collective irrational behavior in markets, we discover contrarian game opportunities. In the game theory framework, when many similar participants make consistent decisions based on the same information or emotions, herd effects form. The strategy quantifies this behavior through 3 dimensions: technical indicator extremes, volume anomalies, and momentum direction. When RSI reaches extremes, it means many technical traders will take the same action. Volume multiplier detection filters normal fluctuations. Only when volume significantly exceeds average levels does it indicate many participants acting simultaneously. Adding momentum indicators ensures the strategy can distinguish real herd behavior from technical adjustments. Only when price momentum significantly deviates from historical averages do we confirm emotion-driven collective behavior. Liquidity traps are classic tactics where big money games retail traders, demonstrating strategic advantages of strong players in information asymmetric games. In the game theory framework, this is a typical signaling game model. Big money creates false breakout signals to induce retail traders to make wrong decisions based on technical analysis, then uses retail liquidity to complete their real intentions. The strategy identifies this game behavior through 2 core elements: technical level breakouts and psychological price reinforcement. Technical level breakout detection identifies false breakouts followed by quick reversals. This behavior pattern usually signals big money manipulation intentions. Adding psychological price levels shows deep understanding of human cognitive biases. Humans naturally have special preferences for round numbers. This cognitive anchoring effect makes areas around round numbers accumulate many stop orders and pending orders. When liquidity trap behavior patterns are confirmed, we identify upward and downward liquidity traps. Institutional money. Flow analysis is the strategy's information game core, aiming to identify professional money movements with information advantages. In the game theory framework, this reflects information value theory in incomplete information games. Participants with better information act before the market, and tracking these behaviors can generate profits during information transmission delays. The strategy analyzes institutional behavior through 3 levels: transaction volume scale, money flow direction, and operational intentions. Large-scale volume identifies institutional-level trading behavior. The accumulation distribution indicator is an improved version of Williams' add-line, analyzing real money intentions through price gravity center, then combined with large volume to confirm institutional actions. The Smart Money Index further refines this concept, using formulas to measure daily money net effects for smart money direction judgment. Nash equilibrium is the core concept of game theory. In trading, it represents the theoretical balance price where all participants reach equilibrium based on existing information. The strategy converts this abstract concept into operational technical indicators through statistical methods. Equilibrium calculation is based on 2 core assumptions. Markets have rational long-term trends and prices follow random walks around theoretical values. Short-term, moving averages represent collective expectations of all participants. This is a dynamically updated game anchor point. Adding standard deviation considers markets' natural volatility characteristics. The deviation rate parameter is optimized based on historical backtesting results, ensuring both sensitivity to deviations and avoiding overly frequent signals. When prices are within the equilibrium range, it indicates the market is in relative balance with equal game forces from all sides. When prices break equilibrium boundaries, it means one side has gained temporary advantage in the game, but market's self-correction mechanism will push prices back to equilibrium. This design allows the strategy to capture both trending opportunities and mean reversion opportunities. Signal generation logic perfectly demonstrates the wisdom of different strategic choices in game theory. Contrarian signals are the strategy's reverse game core. When detecting herd panic selling while institutions are accumulating or lower liquidity traps appear, it creates classic game opportunities. The masses panic sell while professional money accumulates at low levels. This information asymmetry is the profit source. Conversely, when herds chase highs, while institutions distribute or upper liquidity traps appear, contrarian shorts can capture excess returns during emotional reversals. Momentum signals show the wisdom of following the strong in games. When prices are below Nash equilibrium and smart money turns positive while no herd buying occurs, professional money is positioning while the masses have not noticed yet. Following smart money direction can profit during information transmission delays. Similarly, when prices are above equilibrium and smart money turns negative, Shorting captures advantages before trend establishment. This reflects information cascade effects in game theory, where participants with better information act first, others follow later. Nash equilibrium reversion signals are based on game theory's core assumption. All rational participants will push prices toward equilibrium convergence. When prices severely deviate from equilibrium ranges, all sides have arbitrage incentives. Collective behavior naturally creates price reversion forces, whether buying after lower deviations or selling corrections after upper deviations. Finally, comprehensive buy and sell signals integrate three signal types through Boolean logic, ensuring trading opportunities in different game environments. Dynamic position management reflects minimax principles, reduce positions near Nash equilibrium, because strategies tend to balance with lower excess return probabilities. Increase positions when institutional volume appears to utilize information advantages. When professional money acts decisively, following their direction often achieves better risk-reward ratios, achieving dynamic balance of conservative operations during high uncertainty and aggressive advances when information advantages are clear. Strategy execution embodies the optimal response function concept in game theory. Each position opening is based on analyzing and predicting other participants' behaviors. By checking current position status, we ensure we do not overexpose to risks. Stop loss and take profit settings use preset exit mechanisms. The strategy avoids excessive losses in unfavorable games while ensuring reasonable profits in favorable games. The visualization system elegantly displays the multi-layered structure of market games. The Nash equilibrium band design lets traders intuitively see the market's theoretical equilibrium range. This is the core anchor point where all participants play their games. The background color system uses color coding for different game states. Red warns of dangerous herd buying signals. Green suggests herd selling opportunities. Blue identifies periods when institutional money is active, reminding us to watch smart money movements. The signal marking system clearly identifies different game opportunities. Triangles mark key moments for contrarian games, crosses mark trap positions in liquidity games. This visualization system makes complex multi-party game analysis clear at a glance, helping traders quickly identify current game states and optimal strategic choices. The strategy's performance in different market environments demonstrates game theory's adaptability and robustness. High volatility sideways markets are the strategy's golden application scenarios. Game behaviors are frequent. Various signal triggering opportunities are abundant. Herd emotions amplify during volatility. Institutional money takes contrarian actions opportunistically, and Nash equilibrium theory performs optimally. Extreme emotional moments are ideal game environments where herd behaviors are obvious, providing outstanding contrarian opportunities. In bull markets, the strategy profits by capturing herd panic during corrections and institutional low-level accumulation. In bear markets, herd panic selling and liquidity traps create more game value for the strategy. However, we must avoid major fundamental news impacts. Fundamental changes can break game balance and make traditional behavior patterns ineffective. We also need to monitor market liquidity conditions. When liquidity is insufficient, game behaviors may become distorted. Advanced applications require real-time optimization of game thresholds based on market volatility and participant structure changes. By quantifying game behavior intensity from all sides, we can dynamically adjust positions and risk exposure. From professional perspectives of game theory and quantitative analysis, this strategy shows excellent ability to combine theory with practice, but also has some inherent limitations. Strategy completeness performs excellently. 4 analysis dimensions build a complete game analysis framework. From herd psychology to institutional behavior, from liquidity games to equilibrium theory, it covers main aspects of market games. Signal generation logic is clear, demonstrating deep game theory understanding. Risk management shows obvious deficiencies. Fixed stop loss and take profit ratios lack adaptability to changing game environments. There is no dynamic risk adjustment mechanism for different game intensities. Adaptability is the strategy's important advantage. Through multi-type signal design, it can find suitable strategies in different market game environments. However, Nash equilibrium calculation methods are relatively simple. When market structure fundamentally changes, recalibration may be needed. For understandability, although game theory concepts increase learning barriers, the strategy logic structure is clear and visualization design is intuitive, helping understand complex multi-party game relationships. innovation is the strategy's biggest highlight. It successfully converts abstract game theory into operational trading systems. Particularly the multi-party game analysis framework and dynamic position management design have pioneering significance in quantitative trading. Practicality performs well. The strategy shows significant effects in moderately volatile market environments. Overall, this is an innovative strategy balancing theoretical depth with practicality, especially suitable for professional traders who deeply understand market games.